Hello, class. In this session, we're going to I'm going to work the sample exam question related to issuance of stock and how we deal with purchases and resales of Treasury stock. So here's the question. I'm just going to read the question in the fact pattern, and then I will work the various steps on paper. Raz Corporation was organized on January 1st, 2021, with 1 million authorized $1 par common shares and 100,000 authorized $5 par preferred shares. During 2021, the first year of operations, the corporation had the following capital transactions. On January 1st, they issued 500,000 common shares and 50,000 preferred shares for $9,875,000. On July 31st, they repurchased 200,000 shares of common stock at $26 per share. On September 20th, they sold 50,000 Treasury shares at $30 per share. And on December 20th, they sold 100,000 Treasury shares at $20 per share. So first, on part A, it asks, on January 1st, 2021, the common stock was valued at $15 per share, and the preferred stock was valued at $50 per share. Prepare the entry to record the stock issuance on January 1st, 2021. So first we have to determine and understand that we need to use the lump sum method. And we know that we need to use the lump sum method because they issued both common and preferred shares for a single price. Because they issued both the common and preferred shares for a single price, we're going to have to determine the fair market value of the common shares issued and the fair market value of the preferred shares issued, and then allocate that to the sales price. So first we'll calculate the fair market value of the common shares. That's going to equal 500,000 shares issued times the market value of $15 per share. And that will give us $7,500,000 of fair market value to the common shares. And then we'll determine the fair market value of the preferred shares. And that will be 50,000 shares times $50 per share. And that will give us $2,500,000 of fair market value allocated to the preferred shares. We add those two together and we get $10 million. And this is the total fair market value. We will then take our sales price and multiply it by the fair market value of each class of stock divided by the total fair market value. To get the proportion or the amount of the sale that's allocable to that class of stock. So we have $7,406,250 allocated to common. So this is what we'll call allocated to common. Then we'll do the same process for the preferred. And this will be what is allocated to the preferred. Now, to do our journal entry, we have to distinguish which part of each of these goes to the stock account and which part goes to the additional paid in capital account. So to do that, we'll have to go and use our par value times the number of shares issued to determine what goes to the stock account. Remember, what goes to the stock account is always going to be the par value of the shares times the number of shares issued. So in the case of the common stock, the par value of the common stock is $1, and we issued 500,000 shares. So we'll do 500,000 shares issued times $1, and we get $500,000 that will go to the common stock account, which means our APIC common will be the $7,406,250 minus $500,000, or $6,906,250. And then we will do the same process for the preferred stock. So the par value for the preferred stock was $5 per share, and we issued 50,000 shares. Times $5. So that gives us $250,000 of preferred stock. And we'll calculate our APIC preferred. That will equal the $2,468,750 minus the $250,000 that we put to the preferred stock account. That will give us $2,218,750. Therefore, our journal entry will be, we'll use this to make the journal entry. We'll debit cash for $9,875,000 that we received. We'll credit common stock $500,000. We'll credit APIC common for $6,906,250. We'll credit preferred stock for $250,000. And we will credit APIC preferred for $2,218,750. And that'll be our answer for A. Part B asks us, prepare the journal entry to record the repurchase of shares on July 31st. So from the question, it says that we repurchased 200,000 shares of common stock at $26 per share. At $26 per share. So all we need to do is multiply 200,000 shares times $26, and that'll give us $5,200,000 of cost. That's how much it costs to repurchase these shares. And when we repurchase shares, we call that treasury stock. And let's remember that treasury stock is a contra equity account. So we're going to debit treasury stock $5,200,000. And then we're going to credit cash for the same amount. And that's all that is required for B. All right. Step C now asks us, prepare the journal entry to record the sale of shares on September 20th. On September 20th, they sold $50,000 of treasury shares at $30 per share. At $30 per share. Let's remember that they purchased these shares for $26 per share. So here we're going to have a gain. We're going to have a gain. And that gain we're going to put to additional paid-in capital treasury. So for C, the first thing we need to do is determine how much cash we're going to receive. So we'll do 50,000 shares times $30 per share. And that'll give us $1.5 million. And we also need to calculate the cost of these shares. So the cost of these shares was 50,000 shares times $26 per share. The cost of these shares was only $1,300,000. This difference, the difference between these two, would be $200,000. And this is what we're going to put to APIC Treasury. This is our cash, and this is our treasury stock. So we would debit cash, credit treasury stock, and credit APIC Treasury. That is how we would answer C. D asks us to prepare the journal entry to record the sale of shares on December 20th. On December 20th, they sold 100,000 shares at $20 per share. So here we have a loss. So when we have a loss, we're going to first eliminate our APIC Treasury and then put the remaining difference to retained earnings. We're going to put then the remaining difference to retained earnings. So for D, first we're going to calculate how much cash we received. They sold 100,000 shares at $20 per share. That gives us cash received of $2 million. And then we also need to calculate the cost of these shares. The cost of these shares is 100,000 shares times $26 per share. Because remember, this is what the company purchased these shares for. And now the difference here is we have a loss. We have a loss of $600,000. This is the cash. This is the Treasury shares. And this is the loss. And we need to allocate this loss to APIC Treasury and retained earnings. So the next step is we have to determine how much APIC Treasury we have. So if we go back and look at C, in step C, we credited APIC Treasury for $200,000. So if we were to draw a T account for APIC Treasury, we would have over here on the credit side $200,000. So we can debit APIC Treasury at most $200,000, because then at that point it would have a zero balance, which means we will have to put the remaining $400,000 worth of loss to retained earnings. So we can take our total loss, subtract off our APIC Treasury, and that'll give us $400,000 that goes to retained earnings. So when we do our journal entry, we'll first debit cash. We'll debit cash for $2 million that we got from up here. We will then credit Treasury stock. For the $2,600,000. And we calculated here that we're going to put $200,000 to APIC Treasury and $400,000 to retained earnings. And those are both going to be debits because this is a loss. For $200,000 for APIC Treasury, and then retained earnings for $400,000. And that would be our answer to D. Debit to cash for $2 million, debit to APIC Treasury for $200,000, a debit to retained earnings for $400,000, and a credit to Treasury stock of $2,600,000. Then part E asks us to circle one each. The September 20th sale of Treasury stock. It's asking us whether it increases, decreases, or does not change the number of shares issued. Treasury stock does not affect shares issued. Issuance means that we're selling shares for the first time. When we repurchase shares, we're not selling them for the first time. We're repurchasing them, usually to resell later. So it does not change the number of shares issued. However, the December 20th sale of Treasury stock, does it increase, decrease, or does it not change shares outstanding? Well, when we sell Treasury shares, we increase shares outstanding. Outstanding means they're issued and they're not in Treasury. If they're issued and not in Treasury, they are outstanding. This is Jonathan Kern. We just went over the stock issuance and Treasury stock sample exam question. If you have any questions, feel free to email me or stop by my office. I'm available Tuesday and Thursday from 9 to 3:30 and on Friday from 9 to 11 or by appointment. See you in the next lesson.